Okay. So when we were talking about what to do today, we actually got some feedback from some of you. Some of you on the call already gave us some good ideas. And, I think Leslie said, I don't really want a recap of the year. I want to talk about, something that's specific to you guys and that applies to clients in particular. And I've been doing a lot of planning. This time of year is great for planning. Hello, Russell. Thanks for joining us. The chat is not working, but the Q&A is, and we cannot hear you. So if you have any questions, please send them in the Q&A. So when we got together to talk about, what do we want to talk about? What do we think people want to hear about? We kind of just start with these general ideas, and we take about an hour to pinpoint it. And one of them was, I had a client in one of my planning meetings in the last month or two ask a really good question. We were talking a lot about the importance of having a diversified account type. We've got clients who have done this an amazing job over the last 20, 30 years of saving money, and almost all of it is in pre-tax savings because 401ks were the whole thing. They started in the 80s and that's what everybody used. And so now everybody has all this pre-tax savings, and we've had this huge market growth, and people have done a really great job of saving. And then we have the issue of taxes on the back end. And so we're really pushing people to diversify the types of accounts they have. And my client said to me, he was a little exasperated, and he was fine. He wasn't mad or anything, but he just said, we've been hearing for years, we should just be like, put as much money in your 401k as possible. And we did that. And now we feel like we did something wrong. And so we've kind of used that as a jumping point on top of just like Scott and Leslie just giving us some feedback about like what they'd like to hear about and that they want to hear about things at the end of the year. And we kind of use that question as a jumping point. And so we wanted to talk about, we hear a lot, like there's a lot of headlines that say 5 mistakes that investors make, and we don't want you to think of them as mistakes. So we said, how can we talk about this proactively or educationally and forward looking? And what we came up with was, I'm a history person, so I always like to talk about history. I like to make sense about why things are the way they are, how we got to this point, and what to do about it going forward. We had talked a lot about, especially the last couple of years, the market has been a roller coaster, to say the least. We've had a lot of fear, not everywhere. A lot of our clients are very, we've been with them a long time, but some people still get nervous. Headlines are emotionally provoking. Seeing your account balances go down is not fun for anyone. And in the midst of all that, the rules keep changing. Congress is coming up with rules all the time. And so we just truly, I guess, want to talk about how we understand how you feel that way, how we deal with it from our perspective. We're also investors. These are problems that we have to grapple with as well. And just how we think about being positive going forward. And that's sort of our agenda. And in general, we like to be conversational when we do this. We don't want to just talk at you. Please ask questions. We like them. It keeps us moving, and you might have a good question that someone else has. Don't be shy. There are no stupid questions. Truly, this stuff is complicated and it changes all the time. And we are constantly learning as a result. And every single one of you are very different from any of our other clients. So we always learn something new or gain perspective whenever you ask questions. So with that, I'll move on. I think everybody here knows everybody. It looks like we lost some people.
I think sometimes people can sign on and they might get booted off and then they come back on.
Okay, well, we lost a couple people that I didn't know very well. So I was going to say, but I think everybody else knows us. So, you know me, here I am. I don't know if we need to go through that too much.
Yeah, I think that was a great introduction, Danielle. I would just tag on and say, you were saying you didn't want to call it mistakes. And I think that's good. I think sometimes people think they make a mistake in their finances, and then that makes them stop acting. They get scared to make another mistake and then they stop doing anything. And like the point is to keep moving forward, right?
Yeah.
So hopefully I think today we have some good suggestions.
Yeah. Looks like Rick is back on. Just as a recap for Rick who may not know us as well. We've all been doing this for a while. David and I have been working together 25 years. 3 of us are attorneys, or at least trained as attorneys, and don't really like doing attorneying very well, so we do this. Emily over there, raise your hand, is our CPA. She doesn't want to be a lawyer, and we don't make her. And so that's kind of our perspective where we've come from, is just very thoughtful and detailed and number oriented, but we all have different experiences, and we bring different perspectives to the table. So again, there was that question that my client asked, our client asked in a meeting a couple months ago. I can't remember, the days run together these days. And it again is said, for years we've been told to save as much as possible in our 401ks. And now I feel like I've done something wrong. So the point of this webinar is to sort of address that, about why people might feel that way and not to feel that way, and why you hire people like us, because this landscape is always changing and moving, and it's our job to help you move along with it. So when we started talking, again, I'm always from a historical perspective. I'm a history major in my undergrad days before I did the not fun law stuff. And so I always like to think about why things are the way they are. It's very sociology kind of perspective. And the reality is that retirement is a very modern concept. The Social Security Administration was created in 1935. That was less than 100 years ago. It's constantly changing, as we know. Market behavior changes, tax laws change. Tax laws are changing annually now. Emily and I have a tax business. David has a history in tax. Amanda's learning tax. We know that these things are constantly moving, and they're moving far more rapid fire than they ever were before. I even used that word in my slide. Look at me go. I wasn't even looking at it. And our goal is to keep you nimble, to maintain flexibility, not to get too stressed about it, and just to know that you're just going to have to make changes, and that's what we're here for. Do you want to switch? Okay. Back in 1935, when the Social Security Administration was created, people didn't live nearly as long as they do now, as you can see from the chart. But the full retirement age hasn't moved, which means a whole lot more people are retiring than used to retire. And of course, way back when, there was no money. So you worked until you couldn't work anymore, and you were a burden on your family or on society until that changed. So it puts into perspective, I think, about why the Social Security landscape is so different. It was created in a very different environment, and it really hasn't been changed a whole lot. So moving on. So I like to start from the beginning. Pension plans were the original retirement savings, and the very first company to have one was American Express. And I have a little picture there of a horse and buggy, because American Express was not a credit card in 1875. It was a delivery service for currency. It was a very, very, very dangerous job, as you can imagine. They had to carry gold across the country. And so they had to find a way to make their employees who survived it happy. And one of those ways that they did that was to create a pension plan. By the end of 1950, 25% of the private workforce had a pension. Government workers had them as well. And by 1960, that number was up to 50% of private workers were in a pension plan. Moving along, the Revenue Act of 1978 created 401ks. And I did a lot of reading on this in the background, and they were claiming that, at least the information they gave to the taxpayers was that they wanted to give them an alternative to pensions. Some pensions had some trouble. Some pensions were not funded, and they fell apart, and people didn't get the pensions that they'd been promised. And so they wanted to have a diversified option in the form of a 401k, but they also recognized that 401ks were going to be subject to the whims of the market. And that would be very difficult for some people to manage and to plan for. And so I remember one lawmaker, I can't remember his name now, said, 20 years later, I would never have thought that 401ks would have replaced pension funds. Well, of course, 401ks are a heck of a lot cheaper for employers to have for their employees than a pension fund. So that's where it went. And currently it's estimated that more than about $5 trillion in assets are in 401ks now. Then next up, some other smart people realized that, we switch to the next slide. Did Amanda freeze on us? Uh-oh. Well, on the next slide, we talk about Roth IRAs. They were created in the late 90s with the understanding that some people needed a different option from 401ks. And I need to pull up my slide so I can read it. Okay, I just saw the Q&A up there. Oh, we lost Amanda completely. All right. Roth IRAs were created in the late 90s. The difference between a Roth IRA and a regular IRA or a 401k is that the contributions are made post-tax. It's money that you've already paid taxes on, and on the earnings, you'll never pay taxes on those again. And so they've been around pretty much the entire time I've been doing this. And so I've been trying to get people to do them for a long time. It's been harder to sell, to people than others, usually because of probably that change issue. It sounds too good to be true. Excuse me, it sounds too good to be true. But they really are that great. Money that you put in grows tax-free forever, and it is truly invisible on your tax return when the withdrawals are taken after the age of 59 and a half. They also give you some flexibility on dipping into them. Not that we want people to dip into retirement savings, but if you've made contributions to your Roth IRA, then if you had to borrow against it or you had to take some money out, you can always take your contributions out. That's the simple part. I don't want to delve too much into that. We've talked about these ad nauseum, so we'll move on to the next slide. As I mentioned, legislative changes are constantly impacting accounts. Tax rules are not getting any easier, no matter what any president promises. It's not happening. We would all love for that to happen. It's just ridiculous. They also don't impact everyone the same day or same way, nor do they impact you the same way each year. So what your tax situation looked like one year could be completely different another year, depending on what changes are in your life. So much more is on your tax return now than used to be. And they even changed the 1040. Like every time you look at a 1040 form, every year for the last 4 or 5 years, it's been different every year. So you can't even say, oh, line 16 is this, because it keeps moving. Tax laws have a major change on the impact on your savings and your cash needs. So that's something that we have to really stay up on. But more importantly, to this point, or I guess where we get now, is that you have to plan for this stuff. People don't want to pay for it. They don't want to sit down and think about it. They don't like to think about it, but you have to. I mean, you have to. So that's the one thing we keep pushing. Let me see what's on the next slide and see if this question falls into it yet. Yeah, I'm gonna answer this question here. So someone asked, if relevant for today's webinar, I'm interested in hearing about the merits or not of using IRA funds to pay off a home mortgage as opposed to keeping it as retirement funds. I never recommend using your retirement funds to pay off a mortgage, ever. That reason is there are many answers to that, but primarily the cost that you're paying in taxes to withdraw money from your IRA is large. The interest rate on your mortgage is low. So what I usually have when people call me up panicking, they just don't like this idea of a debt on their house, I usually talk with them about coming up with some sort of an overpayment plan on their mortgage to help spend it down slowly, rather than dipping in. Again, this is a very general response. I don't know what, this person's particular financial situation is, but I have never recommended paying off a house with an IRA. I don't know if that covers your
The other point, Danielle, I think sometimes when this comes up is it's at least in part, again, it depends a lot on the individual situation, but in part, we sometimes hear that it's really driven a little bit by being afraid of the stock market when the stock market is volatile or negative or in a bear market. And so they're looking for a safer place to put their money. People tend to think that housing equity is safe. It is in some ways, but it's also illiquid and sometimes hard to access, or you have to borrow it back out.
Right.
But I think that's a concern. And we think the better answer to that, if you're concerned about safety and you want to move to more of a preservation of capital investment structure instead of a growth structure, there are alternatives within the IRA where you can do that. If you really like real estate, you'd probably be a lot better off investing in REITs, real estate investment trust, in your IRA, where you get a diversified, high quality real estate investment, as opposed to a very specific investment in your own residence, where you're kind of concentrating your investments in a non-diversified way. So just from an investment perspective, there are other alternatives within the IRA that ought to be considered too.
I think that's true. And the other important point is that whenever you take money out of a retirement vehicle, the earnings stop. So you're losing years of future income. I mean, sometimes 20, 30 years of future income. That's a lot of money. And when you are, and I guess one of the things I always tell people is, if you think your life is expensive now while you're working and earning money, imagine what it's going to be like when it stops and you have to live off that nest egg that you've created. And so that's the one I always remind people of. If you think it's hard now, it's going to get much, much worse.
Yeah. And I think a lot of times this question comes up with people who are retiring soon or have an eye on retirement. Like, I really don't want to have to make this monthly mortgage payment once I'm retired. I just don't want to have to worry about that cash flow, you know? And so I think it sort of makes sense from that point. Oh, I can get rid of this monthly bill and that will lower my expenses in retirement. But you
Yeah.
also, like the point you just made, it's also going to lower your IRA balance and you're going to lose that earnings growth.
Mm-hmm. And when you pay off your mortgage, of course, you don't pay off all of your house expenses. I mean, you still have property taxes and insurance and upkeep, and it's not going away. So you're still going to need that money to help pay for it in the future. And I think that ties into our next section about just fear. People make a lot of decisions with their money out of fear. And so I think Amanda's going to talk about this section.
Oh, that's great. Because I thought you were going to talk about this section.
I can. Did you want me to
Your
do this
turn,
part real
Amanda.
part? I can do
Oh,
this part real
yeah.
fast.
Yeah, I don't think we necessarily rehearsed this all the way through. So
You're right. When David and I, when we all got together to talk about what we wanted to talk about, we just said, how do people respond to fear or to emotional concerns about their portfolio? And Amanda brought up hoarding cash, and I've got a few examples of that as well, where people are just like, I'm just going to sit in cash. And this year we were like, well, I know the market's down, but guess what? So is cash. Inflation was 9% for a period of time this year. That means your cash is getting a negative 9% return. So cash is not necessarily the place you need to be. As scary as it is to watch things go down, just because you can't see it going down doesn't mean it isn't. We also see a default to passive management. They don't know what to do, so they just buy, the S&P 500, or they just buy a bond, aggregate fund. And we're going to talk about bonds coming up here in a little bit. The other one is just where we hear people coming from with questions. They just say, I read this thing online. My mom said this. My coworker said this. My senator said this. We start to hear all kinds of advice coming out of the woodwork. And some of that is marketing. We remind people all the time that you're going to hear things online or read things online. And sometimes it's coming from a sales perspective. So keep that in mind. And some of it's politics, whichever side of the aisle you're on, or if you're stuck in the middle like me, remember that they're selling something too. And try not to let that overwhelm you. And as much as we love to hear, some productive advice from some parents and friends and colleagues, sometimes, their experience is not your experience. And that's why it's really important for you to have a professional who is not emotionally invested in this, who's going to look at this objectively and look at this for you long term, and not be with you feeding that fear. That was all I got on that one. Okay.
You didn't mention the non-fiduciary security people. We
I
run
didn't.
into that. We run into that all the time. And I think the simplest problem with that is those people have a boss. That's who they're working for. It's not you.
Mhm.
And you got to be careful about what their boss is telling them to sell, because it may not be in your interest. I think that's a key factor there. We don't have a boss in any financial firm. We just have clients as the boss.
Yeah, and we work as a team. So when a client calls us with a question, or we talk about, what do we want to write on our blog this month, it's usually from a good client question. A client will call up and say, hey, I heard this, or this is a change coming up in my life and I want to address it. And we handwrite all of those in-house. Amanda usually smacks us around and goes, you haven't done a blog in a while. So we do write all those in-house. We don't just make them up somewhere, and they're based on our experiences with you and good questions from you guys. So if you're worried about something, please call. I mean, that's what we're here for. And as we learn about changes in legal statutes and the market, we might think we have meetings about you all the time, by the way. we talk about you every quarter. Every quarter we sit down and we grab a good chunk of clients and we say, what's going on with this person? And that kind of keeps us thinking and moving in that forefront. So even if David's been talking to a particular client and we haven't talked about it as a group yet, we may sit down and say, hey, you know, my client brought up this good idea. You know, let's talk about it as a group, and we may incorporate things or do an educational statement on it, or reach out to other clients who are in similar situations and have a conversation to make sure that we're covering whatever it is you need. So I mentioned
And
the word
don't forget
plan
our podcast.
and our podcast. So when we talk about a plan, we have a plan. You know, I tell new clients, especially during a high market period, you know, I say, we're going to come up with a plan, and that plan has to do with how we're investing your portfolio, what your future cash needs are. And we know that years like 2022 are going to happen. We know that there's going to be a negative 20% year. I mean, that's already in the plan. So don't freak out. Like, we knew that was coming, and we planned for it, and we knew that. So it doesn't mean we're like, you know, sometimes people think, oh my gosh, you got to move out of stocks and go to bonds. No, you don't. We already have an allocation to stocks and bonds based on your needs long term, with the full awareness that the market's going to drop and have an unpleasant year. That's just how it works. Oh, we forgot to put that graph in. We have this great graph that Amanda found, and we put it in something. I can never remember where it is. But a study was shown that every year there's a really bad market drop. It's just that when the market drop is extended, then people notice. There are times where that market drop is only 2 weeks or a month. But years where it is like this year, where the market's been down like pretty much all year, that's when everybody notices. But those market corrections happen all the time. Those down markets happen all the time, just like those huge up markets happen all the time. And we're watching them regularly, and we keep those in mind for you. Anything I didn't cover on that one? Any questions? All right. So for example, we're talking a lot about the bond market. We did some changes in our bond market allocation a couple weeks ago. And so we said we would share them with you and kind of talk about our process and where that came from. I'm going to go on mute. I got to step away for just a minute. I'll be right back.
Okay. So as Danielle mentioned, we just wanted to talk a little bit about the bond market. The bond market is becoming more and more important recently. I mean, it's always been important, but if you attended any of our webinars over the past year or two, we've been talking about bond alternatives or what to do in this low interest rate environment, because the Fed dropped the rate really low into zero. But now we're in a period where the Fed has increased the rates, and so bonds are paying money again. So just to give a little background, the bond market, some context, quick history. 1979, that's the year that Volcker took over at the Fed after a period of sustained inflation. Volcker increased the interest rates. It peaked at 14.6%. Since then, inflation came down, and then the Fed has gradually been lowering interest rates over the past 40 years, with some exceptions in the middle there where rates have gone up a few times. And over this time, persistent low inflation has become the norm. Until 2021, we saw inflation spike, and then the Fed responded in early 2022 by hiking their rates. And this brought an end to a 40-year bull market in the bond market. And so a lot of economic commentators have likened this to the Fed taking the sugar away, and here's the kid, you know, having a meltdown from, you know, the candy being taken away from him. Here, I just saw this chart recently in the Wall Street Journal. You can see how extreme this current tightening cycle is. This is the orange line is our current cycle. Other ones over the past decades, you can see 94, 95 previously was the steepest rate hike. Here's 2004. So relative to the recent rate hikes, this one that we've seen this year has been very extreme.
Can we talk a little bit about what a tightening cycle means?
Yeah, so I'm just meaning that the Fed is raising the rates to try to help bring down the inflation.
Yeah. Primarily, it's raising the Fed funds rate at the very short end of the yield curve. In the last couple of go-arounds of the market cycle, they have used some quantitative easing and now quantitative tightening, and by that they mean they start buying or selling bonds, further out, long-term bonds, very often mortgages, as a way to keep mortgage rates down to stimulate the economy or to reverse that cycle. So, but the traditional way is they change the federal funds rate, which has to do with the rates at which banks can borrow money from the Fed.
Yeah. And then David, do you want to talk about this chart too?
This is the Fed's target for some time, since post Volcker, when there was the last big fight against inflation, has been to get the target inflation rate down to around 2%. And this chart down at the bottom is a little complicated, but it shows the first rate increase, and then a year, 2 or 3 years later, what impacts that had on inflation. And you can see generally that after a year or two, not in the first year, but after a year or two, you can begin to see effects on inflation in all those prior periods. And most of them ended up at right around 2%, although that one from 94, 95 actually went down to 1%. The little yellow line at the top, that's the current inflation. It's way different than anything in all these periods back, even through the 90s and 2000s and 2010 decade, way higher. It's also coming down in the first year of the rate hikes, probably not because of the Fed action, because most of the economists are pretty convinced that when the Fed raises rates to tame inflation, there's a delay in the action in the economy. And generally they don't get much reaction for at least a year, maybe a little longer than a year. So the Fed is sort of shooting blind because of that, because they don't get an instantaneous response in what they're trying to change. But we already have a response, and part of that tells you that the current inflation is not all caused by monetary policy. It's also caused by international effects, the geopolitical situation, and changes in globalization and the supply chains. So it's a complicated area, and the Fed is using one fairly simple tool to fight a complicated problem. That's why these graphs look a little strange and aren't as clear as we'd like them to be, but that's what the history is.
Okay, and then now we're moving into 2023, and we want to know, what's coming next. And when we don't have crystal balls, so we don't know. But different economists think different things. One is that inflation could stay high, and it will take a long time for it to come back down. We could re-enter a period where we have persistent low inflation again, or we could see it come down and then get more frequent inflation spikes. That's a view taken more by people who are more worried about supply chains. And here, I think what a lot of people want to see is the investors want Powell, this is Jerome Powell, the chair of the Federal Reserve, handing out the candy again, and the rate hikes, so that the stock market can come back up, and the quantitative tightening, because that's also impacting the bond market. But
oh, sorry, we got a question, so I didn't know.
Oh, okay, you want to
put
take it here?
I'll read it out. It's a I don't know who this is. Oh, we got two. Sorry. Leslie asked 401k and traditional IRA partial conversion to Roth benefits and drawbacks. That was back in our other section. Sorry, I missed it. It's very individual. It just depends. It depends on who you are, how much Roth assets you have, what your tax bracket is, what your future needs are going to be withdrawn. I've got some clients who are never going to spend all their money. Like there's no, they don't need to do it. Other people, they've been in a high tax bracket and they're going to stay that way until they retire. They might not want to do it now. Some people want to do like a little bit each year. It's really a very individual question. So it depends, I guess. I'm sorry, I can't be more specific. And then another one asked, any views on the value of money and how this impacts how much of your managed portfolios will be allocated to international assets in 2023? We have a general guideline for international assets. We're usually between 20 and 30%. David tends to like to be higher, more for an issue of diversification than anything else. US assets tend to be very top heavy in some of the largest companies. So in an effort to diversify that out, we like to we like to buy international, partly because the international managers are very, very proactive. We really like how they work. They're also buying companies that Americans buy into. You know, Americans are huge consumers, and our money is out all over the world. And I'm sure David would probably like to take that answer a little bit further.
Yeah, the the positives are part of what Danielle said, but the other one we think is really important is this is a global economy now, and there are some really good companies that are international companies. They're not just domestic companies, and they're global too. Our companies here in the United States are global, and many of these international companies are global. Toyota is a classic example. So we don't want to be constricted out of that complete universal set of possible investments. And so if you restrict yourself to domestic, which everybody tends to do, people in Germany tend to want to invest in the German market, and people in the United States tend to want to invest in the US market because we understand it, we know it better. It's called domestic bias. It's a well-known effect by the financial professors. So that's one of the reasons that we do that, is to get that other opportunity for growth. But this point is very good. The dollar being strong, which it's been for some time, when you bring those funds back from Europe or Japan or wherever that are invested internationally in those currencies and in those markets that operate in a foreign currency, and you bring it back into dollars with a strong dollar, it's like a big penalty on your investment return. So international returns relative to domestic returns have been depressed for some time because of that. Now, many of us think, well, that can't go on forever because dollar strength often abates. Currencies tend to be very cyclical, and so that's not always going to exist. So we don't want to chase the ball too much and try to time this effect on the dollar, but we do. I think we're tending to let some of those international allocations that we've done that Danielle mentioned bleed off a little bit and become a little smaller because of this negative effect of the dollar. What the Fed is doing and what raising interest rates are doing in our domestic structure of finance, when our interest rates go up, that tends to strengthen the dollar. So right now, when the Fed is steeply increasing rates or increasing rates faster than other countries are, that continues the cycle of dollar strength and then hurts international investment. So that's a very good question, and one that troubles us a lot.
I think I also want to point out that we don't buy international indexes. We never have. So when we buy international investments, they are always actively managed funds that are purchased by incredibly smart stock pickers. And when I say stock pickers, I don't mean to make that sound like they're just sitting on a screen picking things out. They go there, they go see plants, they go read financials, they talk to management. One of our favorite investment managers through the fund is Artisan International, Small and Mid-Cap International, Rezo Kanovich. We've talked about him many, many times. He does a quarterly call with us every single quarter, and he knows his stuff. I mean, he knows his companies inside and out, and he has really good reasons for why he likes to do it. And all four of us agree that we like to buy companies that seem real, that seem like a real place, not just some number on a screen. We like to know what we're buying, and we trust these other people who go out and meet these companies and do their specialty to do that. So we never just buy the Vanguard International Stock Index, because that includes every random company outside of the United States. We recognize that that's not what we want to buy. We want to buy good, solid companies around the world that are having an engaging impact on their local community as well as the global community.
Okay. I just want to move on because we're getting tight on time. So if we can go back to the bond market, I'm going to go over some which is in the bond index as well, which I think ties back to what you were just saying about the international index and sort of the pros and cons. But with all that background on the Fed and raising rates and all that, the key takeaway here is that bonds are paying out interest again. And so bonds are turning into a good place to keep some of your portfolio again. So how do we capture that income? One common advice you hear out there, just go buy the index. I sort of hate this advice for various reasons. I think most of us do. And right now is not a great time to be in the bond index. And I just sort of want to walk through really quickly why that is. So the bond index domestically in the US is the ag. And so what we want to do is what we call look under the hood. What's really in this index? Okay, so we'll take this guy away. We can see in the ag, this is as of December 1st, we have almost 10,000 holdings. We have an effective duration of 6.3, which is a reflection of the maturity date of the bonds. So a little more than 6 years until they mature. And we're getting a dividend yield of a little more than 2%. In that we have 45% government bonds, almost 25 corporate, about 25 securitized bonds, and a very tiny little bit of municipal bonds and some cash. Okay, so what does all of this mean? If we break it down, the government bonds, we have treasuries, pretty long rated treasuries out to 30 years. Corporates, the ag does keep it to BBB or higher in the index. Securitized bonds, that's mortgage-backed securities, mostly other asset-backed securities. And then municipal bonds is, state and city and local governments. So what we do instead of an index in the bond area, and I just want to also point out, this is not investment advice. This is sort of a generic approach. And so depending on our client, your risk tolerance, your time horizon, this could be different. So that I just want to give you an idea of how we think through things for different people. So what we want to do compared to in the index is take this duration. We want it to go lower. And then duration and yield are related. So as we take duration lower, we should expect to get a higher yield. I think somehow we missed the slide earlier with Barry bonds on it, where David was going to talk about the inverted yield curve. But right now, the shorter end of the bonds market is paying a higher rate than the longer end. That's why the yield curve is called inverted. 10,000 holdings, we don't need this many holdings. We can just get the good stuff. We don't need the rest. Government bonds, we don't want to go so long. We want to take the shorter, like I mentioned. We want to get high quality companies, also short in duration for corporate bonds. Securitized, right now, the mortgage rates you've probably seen are really high. This impacts what kind of prices we get for mortgage-backed securities. In general, we think it's not a good time to be buying those. And in municipals, we want to take this allocation in general a lot higher, because right now, local governments and state governments got a lot of money during the COVID relief funds. And so a lot of governments are in a really great position, meaning they're a lot safer than they normally are. And we also saw a very significant repricing in 2022. So there's some really great values out there right now in the municipal bond
Let me
market.
add, Amanda, right here.
I was going to say, does David want to add?
Yeah, I want to add just one
Okay.
thing. Back in the Great Recession, back in 2009 and in that range, there came to be many more municipal bonds that were issued not to be tax exempt. Classic municipal bonds are tax exempt, so you get this extra benefit on your taxes. But of course, they also pay lower rates because they're tax exempt. But there are in the market taxable municipal bonds that we often use in retirement accounts, because your retirement account's not taxable anyway. So you don't really want to put tax exempt bonds in a retirement account, because the retirement account, at least under deferral, is not incurring current taxes. So we use those. Increasingly, we've been looking for opportunities to buy school district bonds. It's just pretty hard in a normal community, especially suburban communities that are consider schools very important. Not necessarily in some weaker towns. People are they're gonna pay their taxes for their school and their school buildings. Those are pretty secure, even though they're very local bonds. But those in general obligation bonds very often could give you yields better than the corporates. It's not always true. Sometimes the corporates are a little stronger. Both of those bonds give you what's called spread. In other words, a little extra interest above the tax, above the very safe government bonds. And so that's why we're looking in these other areas, is to get that spread, that little extra interest And if you can do that without adding undue risk, whether it's a school district or a general obligation of a major state, or in corporates from very high quality corporations, you want to put that as part of the mix in your portfolio.
Cute. And I think unless if you guys have questions on bonds, please chime in, but I do want to leave enough time for Emily to cover some of the tax updates and other things we want to look for in 2023.
All right. Hello, everyone. I haven't spoken yet, so here I am, ready to do your tax update for 2023. This is a slide about, the various types of savings accounts that you can own. And Danielle already mentioned them at the top of the webinar about how it's important to have multiple different types of accounts so that you can pull from the proper place in order to have the most tax efficient withdrawals in tax year. So, and we also got that question from Leslie earlier about Roth conversions. So that is a way of moving some of that pre-tax savings into a post-tax savings, because traditionally we've been told put everything in your 401k, like that question at the beginning of the webinar. And so a lot of people have much higher percentage of savings in their traditional 401k, which is a pre-tax account. So that's one way to balance out some pre and post-tax savings. And then on the next slide, we've been talking about this overarching theme of financial planning today. We got a little more specific about some of the things we're specifically looking at, but one thing we haven't talked about yet is inheritances. That is something that is incredibly important to take into account as part of financial planning. Well, estate planning in general is very important to take into account when you are doing a financial plan. And it's important both for those who may leave an inheritance and then also for those who will be the beneficiary of inheritance. And then for those who may leave it, our biggest advice is to plan ahead of time, if you are able, for tax efficiency, especially because for the beneficiaries of accounts, when someone receives an inheritance, usually one of the first questions is, what are the tax consequences? So there is an entire webinar that Amanda, David, Danielle, and Patrick McHenrick, an attorney over in Tennessee, did back in September, and they go into detail about a list of things you can do before a loved one passes away, and then a list of what needs to be done after a loved one passes away. So definitely we will link to that so you can get some more information there. And so now I'm just going to jump into a couple tax updates for the year of 2023. So we haven't filed for 2022 yet, but once we are in 2023, you can start to think about savings for that year. And I just wanted to point out that the Roth IRA income limit has increased. So if you're someone who is usually skirting around that edge of you're not able to directly contribute to a Roth, the income limit has increased significantly from 2022 to 2023. So when you get your taxes done in 2022, pay attention to your MAGI, that's your modified adjusted gross income. And if you're pretty close to that, to towing that line of 144,000 for single filers or 214,000 for married filing jointly, definitely take a look and see, what you think your income will be for 2023, and if you can potentially directly contribute to a Roth IRA. Another thing that is increasing is not only the income limit, but the contribution limit. So if you are someone who can directly contribute to a Roth, the contribution limit has increased by $500, which doesn't seem like a huge jump, but it's the first jump in several years. And if you think about that $500 that's being saved in your account and growing tax-free, that can be a significant amount if you are able to max out and if you have a long savings horizon. And just to put into perspective, if you can max out, that breaks down to about $542 a month or $125 a week in savings. If you're over the age of 50, you can contribute an additional $1,000 each year. So I think this is my final slide. So start thinking about your questions if you have any. But just a couple things about the Inflation Reduction Act. There's not a ton of changes that will affect individuals. There are a lot that affect businesses, but a few I wanted to point out are the standard deduction increase. Again, it's increased more from 2022 to 2023 than it has in the past several years. And the tax bracket income ranges have been expanded. So the actual percentages of these tax brackets hasn't changed. I have a note in there that the top tax rate is still 37%, but the range of income for each of those tax brackets has been expanded, has increased. So again, if you're someone who's kind of skirted on the edge of the 22 or the 24 or 32, whatever percent tax bracket, definitely pay attention to that when you receive your 2022 return, because in 2023, you may find that, oh, it looks like my projected income for 2023, I'm actually going to be in a lower tax bracket, and this might be a good year to do a Roth conversion or some other kind of, some other kind of.
Well, if I don't mind to jump in, when Emily
go
says
ahead.
that, we don't know anybody who actually knows this on their own.
Right, exactly.
The plug here is to talk to your tax person and have them help you prepare for this. These are knowable numbers. You can plan for this. It's what I do a good chunk of the last third to quarter of the year, is just like, send me your pay stubs and let's see what it looks like. So you can't really feign like, oh, I didn't know, or don't wait till the end of the year. The one thing you can wait for, Emily was mentioning before about contributing to your Roth, and if you're on that kind of that cusp, you have until April of the year following the calendar year that you're talking about to contribute. So if you are kind of on the line and you're not sure and you don't want to like make a contribution and have to fix it or blah, 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 you have until April to figure out what your income is so that you can make those contributions late. We have some people like that who are sort of on the end. And if you do contribute more than you're allowed to, there are fixes for that. We know how to do that as well. So don't freak out and don't do nothing. Don't be paralyzed because it seems hard. This is what we do for a living. So please ask.
Yes, thanks, Danielle. Definitely speak with your tax preparer, speak to your financial advisor, speak to us. Being able to review someone's tax return gives us a lot of insight in what's going on with your tax situation and also in turn with your savings. Those two last points there. So one of the other things that was changed with the Inflation Reduction Act is a removal of, I think, one of the income caps for the premium tax credit. So if you're someone who gets your health insurance from healthcare.gov, there was an income cap that you had to be under in order to receive this premium tax credit, and one of those has been removed. So definitely look into that if you are someone, or ask your preparer financial advisor if you are someone who has insurance through the exchange. Finally, some of the credits for green energy improvements and electric vehicle purchases have been reinstated. These are the same credits that were available, I believe, that were instated back in 2016. And then they went away, and now they're coming back and are extended through 2025 at the moment. So if you're thinking about doing any kind of green energy home improvement or purchasing an electric vehicle, definitely speak to your financial advisor. Don't run out and buy a Tesla and think you can deduct that on your taxes. That's not quite how it works. They're very specific, and they're not huge credits, but it's at least an incentive to do some of those make some of those updates if that's what you were planning on doing them in the first place. So I think we are at the end here. Any questions coming up from anything we've talked about or anything on your
I think
mind?
that was a great summary, Emily. I just wanted to say, do you think that there's going to be any chance they pass any tax legislation here at the end of the year?
I certainly hope not. But we'll see what happens. I feel like usually by now we will have some kind of idea of what might be passed. And it seems like what has been that Secure Act 2.0 has not really made any moves lately. So, but if anything does pass, we'll be the first to be reading about it and watching webinars, and we can do a podcast on it or write a blog about it. So we'll definitely be updated.
Okay.
Yeah.
Well, I don't see any
Alright.
more questions coming in. I think we could go over some of these. I can't get back to that slide, but the slide that Danielle had of different issues that we saw people dealing with, especially this year. Where is it?
It's further up, I think.
This one.
There you go.
So, I would say, if you have been hoarding cash, that's a great position to be in, that you have extra cash. But hopefully now that we've explained more about the bond market and the amount of, better interest you can be getting, that cash needs to be invested in the bond market. If it's extra cash, right? Passive management, I mean, we touched on the index in the bond market. I think a similar thing issues could be said with the equity indexes. Do we want to be passive right now going into a recession, or do you want to be a little more active?
I think the other positive we talked about is these are the common denominator here is that people have money, which is a good problem to have. We're trying to figure out how address the money that we've saved and invested and how to maintain it and how to handle it properly. There's still an awful lot of people who don't have money, saved for the future. And it's a good starting point to remind yourself and pat yourself on the back that you have this money. And it's just a matter of what to do with it.
We've had some clients that have been surprised by inheritance. So sometimes inheritance is people are on the receiving end, and it's not just an estate planning issue. And it's kind of interesting sometimes how their parents or other family members, have a lot of funds that the beneficiaries don't realize they had.
We've had a lot of that this year. It's
Yeah,
been
yeah.
huge.
And then,
I feel like
there's-
I'm getting an inheritance question every 2 weeks.
Yeah, and so there's hundreds of $1,000s coming in, and people sometimes do have a little tendency to hoard that or be surprised or feel guilty that they inherited this money, from a parent or from another family member, and they kind of wish the family member was still around, and maybe they should have spent more while they were alive or something like that. So there are a lot of complicated emotional issues associated with that, as well as just what to do with the money.
Yeah.
Nobody has any questions? Gosh, we're good. We answered them all.
Yeah, well, we did get several questions coming through.
Yeah, we did. I know.
Yeah, we did. Yeah.
I thought we might get some at the end.
Here's one.
I'm gonna fast forward.
Oh, there we go. We don't do options. Personally, I just feel like the market's everything's complicated enough. I don't know options, or it's not something we've ever done.
I think there's different ways to incorporate risk management in your portfolio. Options is one way, but in general, we do a buy and hold approach for risk management. Wouldn't you say?
Yeah.
Yeah, and a careful allocation that's matched up as best we can to the client's objective or risk tolerance. We have some clients that want a lot more bonds than others, just because they want to have a steadier, easier going trajectory going forward. Or they're older and they're more concerned about not losing money just before they retire. Those are specific individual reasons to take a more risk averse approach. We've seen so much abuse of options by people that just got carried away with them, and they're a way to leverage. Very often they're used as you could use them as hedges, but they also are very often used to increase risk in a portfolio, and sometimes those risks catch people by surprise. We're not very convinced about it.
Mm-hmm. What did you? I think one time you called them an easy way to lose money.
Yeah, they are. Yeah,
But I think
because you're leveraging. You can lose more than you expected with those.
Yeah. But I think that gets back to our history, as if for those not familiar with our background, we were historically investing for pension funds. And when you are investing for a pension fund, you have to worry about capital preservation while growing.
And liquidity.
And so I think that approach ties back to that, philosophical approach to investing.
Yeah. We see a lot of investors add these additional levels of complexity and they rarely have paid off. I'm not saying an individual investor doesn't know what they're doing and can't do a good job with it, but when we're managing, lots of portfolios and we're trying to be consistent, it's just not something that makes sense for us to do. Any other questions? I guess if there's any other ideas for another webinar, I know I won't be necessarily up for one next quarter in the middle of tax season, but if other people want to do one, think about questions that you have, or as things come up, let us know. Because like I said, we use it. We use it for internal discussions. We use it when we talk with other clients. We like to hear them. It's good to hear your questions.
And you can always follow us on social media for updates. We try to send out an email once a month. But you can find us here as well.
Mhm.
And I want to thank everybody for coming today.
Thank you.
And sometimes we do a survey at the end of our webinar, and I just remembered I never set that up. So we know pop up, but we do love to hear your feedback. So please feel free to reach out with anything.
All right. Thank you.
Thank you for coming today.
Thank you.
You're welcome. Bye.